Hi there, Phil Rogers, Lauren Hall here from Loan Market Edge, coming to you with our weekly wrap, all that's trending in lending, as we say. Let's talk about a couple of things. One thing that was really relevant I want to spend some time on today is just around valuations and maybe just some changes in the market, a few things that we're starting to see, and maybe helping you better understand that process, I guess, with the banks and what it actually means for you. So I guess we'll talk about valuations first, just in general. So a valuation is ordered on behalf of the bank. So traditionally it will go to an independent third party like a Knight Frank or a 𝗄𝗲𝗽𝗍 will come out and value it. So when NAB orders a val, for example, it's not Mr. NAB that comes out and does it. It is an independent party, again, trying to separate and get some independence on these valuations. But there are generally 8 risk ratings. 4 of those are in relation to the property itself and the security, and the other 4 are in relation to the market. So conscious of how to say this. Yeah, we work with great valuers. There's no problems. I'm just trying to outline this. So traditionally, in my opinion, I'll just say it's my opinion, right?
It's been happening for years and years.
Valuations, the 4 on the property are more factual, I guess, if I'm going to say this right, but more factual on the basis that as the property is, where it's located, the condition of the security in the home the bank is taking on as part of the loan. The other one in relation to the market, it does fluctuate a lot, right? I'm not going to say it's opinion based, but it does fluctuate a little bit based upon, recent and comparable sales. It's a very snapshot in time. The property itself is a bit more long term. The market segments, and definitely at the moment when the market has been a lot hotter than it's ever been for quite some time, there is a little bit of caution, I guess, with some of the commentary that comes in that section and whether that is sustainable. So again, I don't think the valuers do anything deliberately. I think they're actually there to protect the consumer and to protect the bank, because what they're paying is what you're paying for that property market value, right? So they do an amazing job, and it is a tough job, and especially at the moment where the market is potentially in there, a little bit volatile, or there's a little bit of heat in the market. They're worried about, will that come back? Is it sustainable? Is a 15% year-on-year growth sustainable for the value of the property to protect, again, both the client or the bank, if either of those was to get caught in a position. So hopefully I was very diplomatic about how I said that, but explaining.
So I was going to say, so you have obviously the valuation figure, which is on your valuation, which is what a lot of people think the valuation is just built around is what's the amount of the valuation. That is really critical, but also these risk ratings are just as critical. And in some cases, your valuation will come in on the money, no problem, or the amount is fine, but those risk ratings will have an impact still on whether we can achieve finance at the level you need, even if it values in on the money.
And that's probably the purpose of today's chat, is more around those other drivers. So the figure itself, what we have seen as this market, we're now maybe 2 years into this, and there's questions around will it continue to grow at this level, that those market segment comments, commentary around what's happening in general, are where we're coming into a little bit of trouble. I guess the security is always the security. You get rated 1 to 5 on both of these areas, 4 risk ratings, 1 to 5 on each section. The property itself, it's always sort of going to be what it's going to be. When we're talking about that market, we're now starting to see 4s and 5s start to kick into 2 or 3 of the sections.
And that's your most volatile risk rating. So 1 is less risk, volatile. Let's go with that. And 5 is obviously the highest. So when we're seeing 4s and 5s, that's the valuer saying, hey, there's a higher risk of a shift or movement in here.
Is it sustainable? What's happening? Has this end of the market just risen? And so the banks are very conscious of this at the moment, and valuers are very conscious, right? And again, to protect the consumer, trying to understand how this is going to go. So we've now got that position where the 4s and 5s are starting to show up. We've seen some banks start to adjust policies, where traditionally, if it had maybe 1 4 or something in there, wasn't a big deal, so to speak, if it worked overall. But now those 4s and 5s popping up, some banks are adjusting their policies on things like loan to value ratio, meaning that they won't, they'll require a bigger deposit to take on that security to help mitigate the risk that they're taking on, both yourself and the bank taking on in that position.
And remember, if you are looking at LMI as well, you don't just have the bank ticking that off. We've also got the mortgage insurers policy on that. So the mortgage insurers are starting to adjust in that space as well. So that's where sometimes, again, that bigger deposit's required, because the bank needs to remove the mortgage insurers policy from that as well.
Yeah, and there are, as part of that, remembering the bank and mortgage insurers have policies around postcodes, around certain locations, around the type of building,
size,
over 10 floors, is it again a particular postcode, is it high density, there's all these little things that happen, service departments, for example. So there's all these things that happen in the background, that again, we go, did the valuation come in on the dollar? I was like, yep, cool, but that's 1/10 of the assessment for risk for the bank looking at your particular property. Also, for yourself, both yourself and the bank, right? So again, this is to protect the consumer as much as is the bank. So it's not, I'm not driving on again and pushing on that it's the bank's fault or the value's fault or anyone. Everyone's there to protect everyone, right? But it's understanding how this works. And as these banks learn on the fly as well, and they start to adapt, and their level of risk or their appetite for risk changes in certain areas. The benefit, obviously, of working with, aka the dream team brokers, mean that we know who's changing these policies. We've got a finger on the pulse. We know if there's going to be an issue. If one particular bank requires a 30% deposit in one postcode, we've got another one that'll do 95. Yeah, we've got some lenders that will go, okay, well, we're actually happy with the security, we'll ride the market, we're fine with those conditions, where others have gone, if we see 1.5, you've literally got to increase your deposit to 30%. So part of that research process and part of the journey for our clients, well before we get to a bank, working in your best interest, is to unpack all of that. What are you looking for? What do you need? What's important? Where are you looking to buy? Asking these sorts of questions will form a really big part of that research. So when we come back with recommendations, it's very much in line with what you're looking to achieve. And we're going to a bank that we know will cover off all of those items. Not just now, but in the future if you're making changes.
Absolutely. And we've seen that this week, just with the clients we've been working with this week. It's really become apparent, these valuations. We've had some clients that have come to us where the valuations have come under what they were, what the purchase price was. Other banks' valuations, no problem at all. We've seen the risk ratings start to have an impact. Again, some banks, no problem. Others, yes, that is a problem. So it's really started to be evident how the risk ratings are starting to play a part in that. But the ability to be able to shift between banks will give you guys that clarity around, hey, potentially this is what might need to happen. We might need more deposit, or we might need to look at a different bank or get another valuation. Is just critical for you guys to have people on the front foot who can move really quickly through that, as opposed to finding out at the 11th hour that there's a problem.
Perfect world, we're understanding that before we lodge your application.
Absolutely.
Not after you sign the contract. So FYI, another reason to get in touch with us earlier than later, to help avoid this and help make sure that you are with the right bank and we go through a great experience. We spend that little bit of extra time up front, in the process, but again, we work for you, not the bank, so it's a very different process. We're not submitting just one option. We go, well, let's sit back, let's unpack all of that first and come back to you with those recommendations that are very much customized to your needs and your wants, etc. Hopefully that makes sense. That's telling you a little bit about what's happening with valuations. We thought we'd touch base on that a little bit this week.
Very much trending at the moment.
Very trendy. Well, I'm very trendy. That is very trending. I am very trendy. So if you guys have questions, by all means reach out. We've answered some really good phone calls this week with both agents, a lot of referrers wanting to know about this, but also a number of clients that are in that position. So again, earlier the better, get in touch. And we'd love to have a chat. For now, have a great weekend, a wet weekend where we are here on the GC.
Won't be very exciting.
I'm told up north is a whole lot nicer, so enjoy the weekend, and we will talk to you soon. Bye for now.